You are listening to Keystone's Stock Talk Show, episode 274.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
We are back from a 10-day adventure to Orlando. It's great to chat with you once again. I will start this week with a quick look at 5 traits we look for to help us identify potential 10x stocks. Aaron reviews the top 5 ideas from Ben Graham's legendary book, The Intelligent Investor, including investments versus speculation, value and margin of safety, the importance of fundamental analysis, avoiding market timing strategies, and the importance of emotional discipline. In our Star and Dog segment, Brett takes a look at Star, Bright Minds, Bioscience, symbol drug or DRUG on the NASDAQ, and Dog, Lucid Group, symbol LCID on the NASDAQ. Bright Minds is an early stage drug development company. It's had an astronomical rise over the past month from around $1 to $55 range. Brett will let you know if the jump is justifiable or pure speculation and if the stock is vulnerable to a collapse. The Dog, Lucid Group, LCID on the NASDAQ, designs, engineers, and manufactures electric vehicles. The stock is down 26% over the past month, 95% since its all-time high hit in 2021. Brett lets you know if this dog should be taken behind the barn and shot or if there's a potential opportunity. In our Your Stock Our Take segment, Brennan answers a viewer question on BluMetric Environmental, symbol BLM, on the TSX Venture, a microcap which provides clean tech technology, environmental consulting, essentially professional services in the fields of environmental geosciences, engineering, industrial hygiene, occupational health and safety, renewable energy, water, and wastewater treatment. Brennan looks at BluMetric's current fundamentals to see if the company fits our growth at a reasonable price criteria. Okay, now let's get to the show. My co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Good.
How are you?
Good.
How was the hurricane?
Yeah, it's been a couple of
Florida.
weeks since Ryan's done a podcast, and a lot has happened. So
It's true. I mean, we were down actually in Orlando as Hurricane Milton hit. It thankfully missed Orlando or didn't hit it to the extent that it was originally expected. There was a ton of wind. We had some sideways rain. Trees were fallen or felled. And there was, I told the story. There was this giant pot, about 8 feet by 8 feet that was kind of round and had the huge tree in it, rolled over, almost went into the pool. So, stuff blew off the roofs. But overall, we were in a concrete building. And what kind of gave us a little more confidence in where we were is everybody from Tampa. There was a ton of people from Tampa. The busiest night when we were down there at the resort was the night of the hurricane. They all came up to this region and this hotel, which was great because that's where everybody kind of bunkers down for a storm like this. And it was amazing how resilient the people were there. Not in the areas hardest hit, obviously. Our heart goes out to anybody who lost anyone or anything in those areas. But, within a day, people were back, filling the parks of Universal and Disneyland. And, the cleanup was quick. And we were there again right away. So it was amazing to see. But it was, a little dicey there for a day or something, but we got right back at it, and then we spent some great time. It's great to have a 9-year-old at Disney World and Universal. Harry Potter World there was amazing. My daughter, if you ever go into Universal, they have this you go into Ollivander's wand shop and you can get picked. Somebody gets picked out of the crowd, and she was wearing her kind of Hogwarts gear, and she got picked and did a wand reading and got a wand. It was pretty awesome. Got that on video, which is great. So we did all that and went to Disney World as well. And it was great. Good times. And then myself and Aaron, the last 2 days, did the money show.
Yes, I did. I did head down there, and I was paying close attention to the forecast to make sure that there is nothing else expected to hit the state of Florida while I was down there.
And we didn't have any power outages or anything, which was amazing. I kept telling Aaron how hot and incredibly humid it was there. And it was for literally 9 days. And then the 10th day, I think Aaron came.
It's actually cold when I arrived.
Yeah,
I arrived.
Unbelievable.
The cab driver he looked like he was freezing. And
they're 25, 26, and it got up to 29 with the humidity. Felt like it was like 38, 40. That's what they were saying. And it really did. It was. And then on the day Aaron arrived, I think it was 20 with like zero humidity relative for that area. And it felt for us who've been there for like 9-10 days, it felt freezing. Right. And I'm sure everybody felt that, and people were suddenly wearing sweaters and everything where where basically people, Brennan was running around in his underwear at Universal Studios. Right. But, you felt like you could be, and it was warm enough to do that is what I'm saying. But yeah. And then, so Aaron got there and he was freezing and said I was lying and there was no humidity down here.
No, I think my exact words are you're just weak. You can't handle this little bit of heat.
It is crazy though. The humidity is quite. I don't know how people do it when it gets up to like 35, 40 in the summer with humidity, because there was a lot of people that looked like they were dying down there in 25 and 29 degrees with humidity, and like people are in that park where you're just shoulder to shoulder. I'd be literally firing off. Get away from me.
That reminds me when we were on a work trip to Vegas, Ryan and Brennan and myself, and we're outside walking around, and Brennan was just like, oh, I just can't stand this heat. And I turned to Brennan and I called him soft. And he laughed at me and he said, buddy, I'm from Saskatoon where the winters get down to like, you're from Vancouver, you're calling me soft? And so, yeah, fair enough. Yeah.
Point. I was even saying that to Ryan while he was down there. I was just like, oh, thank God I'm from Saskatchewan where we don't have to put up with hurricanes. I mean, I know that you guys, no one in Canada does, but, or at least on this side. But yeah, I would definitely put up with the minus 40, way over these, natural disasters. Again, obviously we have, our odd tornado and whatnot up here, but, yeah, I'm too soft to be in a hurricane. That's for sure. Cause, I would have been calling 911 in the,
you would have, it was loud as hell. Like the wind was like, everything was sideways. It was crazy. I was in Orlando for that. And then I touched down on the way back on Saturday, I think in Denver, and there's like tornado warnings, and like you guys walking through the Denver airport, and I look to the right and I'm going to go, and the men's bathroom, it says tornado shelter. And I'm like, is everybody seriously, trust me, you don't want to go in there at the best of times, but you're going in there. I guess it's because there's no windows, but I'm like, geez, that just like two types of hurricanes and tornadoes that we just on the coast here really haven't had to deal with ever in Vancouver, and just two different realities that we don't have to deal with. Huddled down in a men's bathroom.
He chased a hurricane out.
Yeah, I basically am. But when I came back here, there was an atmospheric river, so I just think the storms are either just getting right. They're either following me or something. I don't know what's going on. Mm-hmm. But I did tornadoes, atmospheric river, and hurricane over the past like 12 days. Crazy. No one wants to hear about that. Let's get to the show.
No.
We got a poll question, right? Or you know what? I was going to tell people too that we do have our upcoming webinars, which is great to tell people as well. The new stock portfolio, dividend growth stars as rates fall in the next 10x stocks. So that's November 7th, 7 p.m. Pacific, November 12th, 7 p.m. Eastern, or you can do the complete VIP stock portfolio building package. That's November 16th, 11 a.m. Pacific. That's 5 hours, or 2 p.m. Eastern. That would include 1 year membership to our VIP, 5-hour live and on-demand webinar, 15 high conviction growth stock buys. But those the November 7th and 12th, who should attend those? We say investors looking for unique, profitable stock recommendations, dividend and small caps, and advice on building a better 15 to 25 stock portfolio. What's included this time? I'm going to give you 9 traits on how to uncover the next 10x stock, the simple formula that allows Keystone to identify and recommend 10 and even 200x stocks like the Hammond Powers of the world, which is up 2,400%. We're going to look at with rates falling, dividend stocks are rising. So don't miss out. Get our top 3 dividend growth stocks for 2025. And if you look, why should you attend? Well, we always say proof is in the results. The 2 recommendations that we had around last year's fall 2023 core webinars, 2 cash-rich stocks. The first was Cipher Pharma, profitable growing specialty pharma stock, then traded $3.89. Today is $16.50. It's up 225 or 325%. Vital Hub, profitable growing healthcare company, then at $3.25, now at $9.50, up 192%. So you attend this webinar, you're going to get our top cash-rich SaaS stock, top dividend growth stock, 5% plus yield, cash-rich profitable gold stock, 2 top performing unknown digital financial stocks, and 2 cash-rich small caps trading in and around $3. You get, with the VIP ticket, the last thing I'll say is you get a top 4 dividend growth stock report, fall 2024 mid and US growth stock report, if I can say that, and the on-demand webinar, how to find the next 10x stock. All right, that's enough. Let's get to the poll question, the actual show, folks.
Yeah,
what do we
the
got?
poll question for the week was on the fact that Chinese stocks have recently surged dramatically, and you can look at the Hang Seng, the Shanghai indexes for those. Do you currently invest in Chinese stocks? 18% of our viewers said yes, and 82% said no. So roughly 1/5 of our viewers are actively investing in Chinese stocks, which is quite interesting. I'm not surprised it's a relatively small amount since they are relatively risky. They're not included in even as many indexes when you're looking at the US, if you're looking at the ADRs in the US. And they've just been out of favor really for the past 2 or 3 years. And I will mention the reason behind the surge is that there was some economic stimulus, fiscal stimulus given by the Chinese government. So it really just put a bit more higher hopes, since the Chinese economy over the past few years now has really been slumping down lower and lower. They've already done some interest rate cuts. They did actually some more after this surge in stock price earlier, I think it was late last week. But yeah, so it's been a very volatile month for Chinese equities.
Yeah, if you look at Alibaba, which is one of the larger Chinese-based stocks, started a month ago at about 89, went up to 117, and is back to about 100. So there was a surge, come back. And you look at the fundamentals on Baba, they look decent, 10 times, 11 times forward earnings. But again, we would always, if you're pricing these companies, price in a significant discount because there's a ton of geopolitical risk there. So I'm not sure if these companies, at one point they got higher valuations. I'm not sure if they're going back to a time where you're going to get a premium valuation, even on what would be, for example, Alibaba, considered more a premium name in that market. But they're only getting low single digits to maybe mid. The 15 range PEs in that range, but a 10 PE might be what you're looking at until there is a lessening of geopolitical concerns. I don't think that's happening anytime soon.
Well, I mean, it's stocks based in China have even trading in the United States have been trading trading at
fraudulent
a discount for many years, and there's a couple reasons for that. One is that there's some hesitation in terms of how much the regulators and the auditors can really monitor a company that's operating in China and trading, say, in the United States or in Canada, right? There's been situations in the past where fairly large companies, one that going way back, Sino-Forest, very highly touted by many big institutions in North America, turned out to be completely completely falsified financials. Stock price essentially went down to zero, shareholders losing all their money. So the market still remembers that, right? And there are some great companies, I'm sure, operating in China, but it's very difficult to know even if you're looking at a company that's reporting a lot of earnings and cash flow, how much can you really trust that? But then even when you go up to the Alibabas, I think they have the credibility where, this is a legitimate company with legitimate technology, but it still is subject to a lot of the same political risks that any company in China is going to be subject to, right? Like in terms of how, the corporate world, the economy, and the political world are integrated in China, it's at a completely different level than what we are used to here in North America, or even say in Western Europe. In China, essentially the government picks the winners, right? And it's a hard market to invest in. It's hard philosophy for us to invest in. So we've just generally been avoiding those companies. Now, companies that are largely operating outside of China, but then also have some exposure to China, that's a different story. If you want to get exposure to the China's economy, but in terms of investing in companies that are actually operating in mainland China, there's a lot of risk there. And even with a discount, where there is a huge discount, I just don't see that as being sufficient to compensate for the risk.
Yeah, another company that I'd like to just mention is like Luckin Coffee, which I've in one of our sweeps I came across it. It's like, oh, fundamentally this company looks good, and Ryan's like, Brennan, they had a massive accounting scandal in 2020 where they were they were actually fabricating like transactions. So just to put it into perspective, so Luckin Coffee was founded in 2017. They're kind of like the competitor to Starbucks in China. But essentially in 2020, it came out that they had fabricated over $310 million in sales transactions through like this elaborate scheme where they were essentially just making up transactions and making up revenue that wasn't even there.
Mm-hmm.
So, again, these are just things that you gotta stay cognizant of. It's not that we won't look at companies there. But again, even if we did recommend, a company that has exposure or is based in China, it would definitely be on the higher risk spectrum, probably end up in our discovery portfolio. And it would be tough for it to, graduate to the focus buy portfolio, just given the risk. And like Aaron was saying, I don't know if they ever will, get rid of that discount that they have just because of, these scandals that continue to go on.
Yeah, even further, just the share structures, because they are ADRs, which is American Depository Receipts,
Yep.
is you're not actually directly owning the shares. It's a deposit to have the same economic value of a share, and those can get disconnected completely. They can be removed from the system effectively. You saw that when the Russian invasion of Ukraine, the Russian depository receipts, it was primarily on the London Stock Exchange, just went to zero with sanctions, even though the operations of the underlying company still existed. It still went to zero because those shares, the ADRs, or I guess London depository receipts, went to zero.
Mm-hmm.
All right. Well, let's get into the heart of the podcast. So this comes from our webinar where we talked about looking at 10x stocks. And really, we're talking about these type of stocks, 10 to 200x stocks from our research, such as Hammond Power, Boyd, Water Furnace, Boyd, Expel, Janus Systems. What are some of the core criteria in the profile that we're looking at to identify these stocks? So we gave 10 there. There are more than 10 that we look for when we're looking for individual companies. But I'm going to present today 5 of the 10 criteria we presented at that live webinar. Now, the first that I'm going to look at in the profile of a 10x stock, most companies, again, won't check off all of these, even if I went through 10. But if you can check off, say, 7, 8, 9 of the 10 elements, the better chance we have to uncover the next 10x stock. The first element that we look for is profitability, or real cash flow and earnings. Why do we require every small cap and every stock, for that matter, small or not, to be profitable from current operations before we invest in it? It's because the data is heavily on our side. And we'll look at a recent study on the data that looked at 10x stocks from 2012 to 2022 and how many stocks actually increased 10x over that time. Well, what are the core criteria? 87% of global equities or stocks that went up 1,000%, 10x or more over the past 10 years, started small. 82% of those were profitable at the start of their ascent, and 91% had some history of profitability. So when you're looking at profitability, make sure you're looking at cash flow and real earnings, not analyst or management's favorably adjusted figures. So the next element that we would look at is a strong balance sheet. Best case scenario, the company has significant net cash position, which would be more cash than debt, and is able to fund operations and grow with cash on hand. With plenty of cash on hand, the company does not need to be asking bankers and shareholders for permission to expand. Plus, when times get tough, and they always can, a strong balance sheet provides a cushion exactly when those bankers and shareholders are most reluctant to provide more capital. Now, a strong balance sheet also gives the company power and flexibility in downtimes to not only weather the storm, but to play offense and make acquisitions when other great businesses are on sale. We saw this from one of our core focus buy recommendations, a company called Firan Technologies. During the pandemic, they were able to build up cash when essentially the aerospace industry was shut down. Some other businesses that didn't have that cash on hand, that net cash position, were in a tough situation. They were able to buy a couple of businesses, one primarily at a price they liked, and have been able to accelerate their growth coming out of the pandemic. And we've seen the share price go from around $2 to over $6.50. So finally, the company can continue with this strong balance sheet to make the necessary investments to stay ahead of the competition, which is something we always need to see. You can't just be good today. You got to be good tomorrow to be a good long-term stock. So you need to invest in being a better business tomorrow as well. Attractive valuations is the third thing we look at. Not necessarily the cheapest stock on the market, but are you able to buy that business or stock at a discount to what we would call the intrinsic value or fair value of the business? Whether using past or future earnings, book value, discounted cash flow analysis, or hopefully all of the above, does the business trade at a valuation that is significantly lower than its current and future value? And is there reasonable indication that the growth is sustainable? So number 4, we like a strong management team. Now, how do we measure the strength of a management team? There are a number of ways to look at it. Fundamentally, you can look at ROIC, or return on invested capital, or ROE, return on equity, give you an idea how well management allocates the capital under its control to profitable investments. Now, there are limits, and one has to look at of these ratios, and one has to look at each company on a case-by-case basis. Other ways we like to track management internally is whether or not they hit their targets with a degree of frequency. This increases our confidence in the future guidance and our forward estimates on the company. So if they tell us in one of their meetings, we're going to earn 10 cents per share in the upcoming quarter, and they hit or exceed that, they can get a check off in our book. If they miss it, the opposite is also true. Now, we want to stress that this is a management team, not just one individual, if possible, as key executives can leave the company. So that can be a risk. We like to see significant ownership with those key executives and the board in the business as well. A high level of ownership by top executives ensures that the interests of shareholders are aligned with the interest of management. Management is then less likely to do many of the stupid things that poor management teams do, such as chase top-line revenues for the sake of growth, but not for increased profitability. That is bad for shareholders long-term. We like them to be aligned. It aligns them to produce what we call, and what the market looks for, that's per share earnings and per share cash flow growth. This drives stock prices higher over the long term. Ideally, you might be looking for ownership between 5 and 40%, but it can vary based on the size of the company. If it's more than 50%, the principals can be in a position to reward themselves with lucrative compensation packages rather than serving the interest of shareholders, because basically they have the final say. And if it's less than 5%, there might not be enough alignment with shareholders. Again, that would depend on the size of the company. If you have 5% of a $10 billion company, you have a significant stake in that business at that point. Now, these metrics cannot always be achieved. At times, a founder who owns a significant stake in a business is not a great leader over the long term. So a better leader with less stake in the company can actually do a far better job. Aligning that person over time with shareholders would be a goal. Insider ownership should be investigated, as most of these metrics and criteria that we're looking at today, on a case-by-case basis. Now, those are 5 of the core criteria. There are many more that we use to help us identify good 10x stocks for the next potential 10x stocks to invest in. But that gives you an idea of 5 of the core criteria that we look at when we're looking to find a great investment.
Yeah, and today I'm actually going to be looking, like, on the Your Stock Our Take that I'm going into. I'm going to look at insider ownership and exactly how much the CEO owns, as well as just management and board. Just we can kind of go over a little bit of a case.
Yeah, and I know the company you're talking about, and
exactly.
we interviewed management, and the management seemed very competent, but the insider ownership was very limited by the key executives there, and they had actually at one point sold.
And I do
exercised options and sold,
yeah.
And we're kind of happy with that. 20 cents to 70 cents, and that was an indication for us as and it was over a short period of time, relatively speaking. Indication for us is the business and the fundamentals look good, but is there? Why are you selling at that point, and why are you happy with that short-term gain? In a business, and this was a business that is contract driven and has had large fluctuations in terms of their revenues, not really a ton of growth over a 10-year period. And I just basically stole your segment. Right there.
Well, yeah, I mean, exactly. That's fine.
No,
but like exactly that.
Why he doesn't have to do a segment? He can just take.
You're done.
Ryan's always doing this, but no, it's good context. And that's the thing. Like, why would we want to be recommending the stock to our clients to buy the stock if you're exercising these options and then just selling them into the market? If you don't, have the thought, why would we be doing that? And again, it depends certain circumstances with a CEO and whatnot. I think in that specific circumstance, like he had said that they were selling shares to a big block to someone who wanted to enter a position. But still, again, like, as a CEO, don't you think you'd want more skin in the game if the outlook was rosy?
My question would be yes, or my thought would be yes, and that was raised kind of. It's not. It's a red flag that didn't fit off our criteria, and we didn't check that box off, and that company wasn't recommended at that price. And, the stock moved back from there, really. And that's been the high point for that company. But again, if there was a selling of shares and they owned 10%, they owned 1 million shares and they sold 25,000, like, who cares? Exactly. But if you own 100,000 shares and sell 90,000, that's a big deal, right? So, and there should be a reason that could be more justifiable than we saw there. All right, that's going to end that segment. Let's move on. Aaron's going to look at the legendary investing book. There it is, The Intelligent Investor, Benjamin Graham. Warren Buffett says it's the best ever written.
This is the first book on finance I read when I started my career. And I would agree with Warren. It is an incredible book, full of a lot of brilliant principles. So we did receive an email request from one of our listeners about doing more content about the books that we read and some of the big ideas that we get out of those books. So right when I saw that, the first book, obviously, that came into my mind was The Intelligent Investor, which is, I would say, one of the great classics of investing. So if you are a stock investor, that's a book you're going to want to read. But why don't we just get into the presentation here, and I can talk about what I think are some of the most important ideas of this book. So as we were just discussing on the podcast, Ryan is great at stealing people's content before we have a chance to talk about it ourselves. I'm joking. But it is true. Ryan mentioned that Warren Buffett has given a very strong review of this book. Benjamin Graham, who was the author of this book, a legend in the field of investing, is actually one of the big mentors of Warren Buffett. He was a professor when Warren Buffett was studying finance in university. Warren Buffett also, I believe, worked for Benjamin Graham for a period of time as well. And he says that The Intelligent Investor was by far the best book on investing ever written. So if Warren Buffett is going to give an endorsement like that to any piece of information, I think that any stock investor would be definitely recommended to invest the amount of time needed to read that book and learn some of the principles, just based on Warren's endorsement alone. But we also endorse this book. I believe, Ryan, you've read it as well. And as I said, it's really a book that kind of opened my eyes to how stock investing worked, beyond what you would necessarily read in like an investing 101 textbook or what I would learn in school. More about like the practical application of investing. And this book was written, I believe, back in the early 1930s. I'll have to check that, but around that time. So a lot of the things that Benjamin Graham talks about, you can tell, are a little bit dated, but the general principles still hold true today. And so what do I believe are the top 5 ideas from the book? There are many great ideas and things to learn from this book, but the 5 I'm going to focus on are the difference between investment and speculation, the concept of value investing and margin of safety, the importance of fundamental analysis, avoiding market timing strategies, and then also the importance of emotional discipline. So let's start with investment versus speculation. What is investment? Investment is when you commit capital to something based on thorough analysis, and you're focused on both safety of principal and adequate returns on your capital relative to the risk that you're taking. And all of this is based on an analysis of the actual fundamentals and financials of whatever it is you're investing in. Speculation is engaging in risky transactions aiming for a quick profit. You're not really basing your investment outcomes or potential investment outcomes on analysis. You're just basing it on a hope. So there is absolutely nothing wrong with going to Las Vegas and saying, I've got $200. I'm just going to gamble and see what happens. But it is definitely problematic if you consider that investing. And unfortunately, too many people in the market don't really differentiate between investment and speculation. So distinguishing between the two really helps you to avoid unnecessary risks and promote your long-term financial success. So when you understand that you're speculating in something, same with my example of going to Las Vegas, this is about fun. This is about, I could make money. Likely I will not, but I have a certain amount that I'm willing to lose, and I'll just throw that in for fun. And then maybe I'll be lucky and actually come out with a good outcome. As long as you enter into stock speculations with that mindset, then there's nothing wrong with speculation. The problem is when people enter into stock speculations, confusing them with investing and actually thinking that they're investing. So practical application of this idea, focus on investments that are backed by solid fundamentals rather than just chasing trends or hot tips. If you don't know anything about the fundamentals, when I say fundamentals, I mean the actual business, like the product, the service, the revenues, the earnings that are generated, what the balance sheet looks like. Is there too much debt? If you don't know anything about the fundamentals, then you are, almost certainly speculating, even if it is not a speculation. So if you're just understanding the trend, if you're just hoping that the investment is going to work out well, and you're making a bunch of assumptions, then that's a speculation. So you never want to speculate with money that you can't afford to lose. Now, investing in established companies has proven to be the best strategy in terms of risk-adjusted reward for investors over time. And a lot of people think that to get the big returns, you have to speculate. That is absolutely not true. Just look at a couple examples from our research, from Microsoft to Boyd to Hammond. Solid, profitable businesses, real companies that produced returns well above, most any of the speculations that we've seen that have actually worked out well. So investment versus speculation, very important to understand the difference. Number 2, value investing and margin of safety. So Benjamin Graham is talking about here is buying securities or buying stocks or any type of investment below their intrinsic value. And that this provides a margin of safety. So if you're buying it below the intrinsic value, then you can afford to make somewhat of a mistake in terms of assessing what the intrinsic value is. And you'd still be making a value investment. So this protects against errors. It protects more against market downturns. It just gives you some safety. Why this matters, margin of safety will reduce your risk. And you're also always looking to invest with the lowest amount of risk for whatever return expectation you have. So it's not about investing is not about just chasing ideas that you think will produce potentially huge returns over time if everything works out. It's also about managing risk and focusing on risk adjusted returns. So practical application, really looking beyond just the story of the company and looking into the actual structure of the company in terms of, what is the business model? What are the products or services? This really comes down to fundamental analysis. And this is what's necessary to determine a stock's true worth. And you really only want to invest in that company, according to Benjamin Graham, if you're able to buy it at a significant discount. Examples from Warren Buffett's investments. One might be Coca-Cola. When he first purchased that company, I believe back in the 1980s, he ascertained that it was trading at a significant discount. And, really it only takes, I think Warren Buffett said that it was only about a dozen or so investments that have resulted in, 90% of his success. And this success has come from focusing on that margin of safety and value relative to the business. Now, importance of fundamental analysis, and I did talk about fundamental analysis in the value investing and margin of safety idea, but I wanted to just really drive that point home because it's something that most investors don't really think about when they're purchasing stocks. In a lot of cases, they don't have the expertise to really understand the fundamentals of a business, which is why a lot of people will utilize our research. But this is really a thorough analysis of the company's financial health and financial performance. And this is what is necessary to determine whether or not you're purchasing a company at a reasonable price and getting that margin of safety. So what you're doing when you're focusing on a company's fundamentals or financials that are actually available and reported, as opposed to just listening to what management is saying, or listening to what people on the internet are saying about a company, is you're grounding your investment decision in actual facts and data, as opposed to just emotional discussions and promotions. So what is it? The practical application of fundamental analysis. This is when you're evaluating the earnings, the revenue. You're also looking at, the company's products and services, what kind of competitive advantages they have. But really it comes down to the way to validate those competitive advantages really comes down to the financials of the business. So the revenue, the earnings, and then also as well, what is the debt structure, and is the company overloaded with debt, and is that a risk, or does the company have excess cash on its balance sheet, which it can then go and invest in order to grow? One of the things when we are in speculative bubbles, that's when people are looking for the next hot thing. They're looking for trends. They're listening to promoters a lot more. They're getting a lot of their information on social media. Financial analysis really helps investors identify companies that are actually doing well, not just that are part of a trend, which people believe are going to do well. And a lot of times you will find those fundamentally strong companies are actually part of these key trends. And those are the companies that we would want to focus on. And if that key trend, like say AI or technology innovation continues to be strong, then we would expect that to result in a continuation of growth in revenue and earnings per share for the company. Big idea number 4 is to avoid market timing strategies. So the key idea here, trying to predict the market highs and lows, is speculation by definition. For the vast majority of investors, it's going to be very unsuccessful over time. They may be successful on individual trades, but individual trades are not important. What's important is your aggregate return over time, long-term. So long-term investing is just empirically a more reliable method of generating investment returns, and it also requires less of a time investment than would a market timing strategy. So avoiding market timing reduces the risk of missed time trades and potential losses. That is true. But, as many traders will say, you can be right from time to time, but it is very difficult to be right all the time. Although you don't have to be right all the time, you have to be right enough to justify your market timing strategy. So what I tend to see a lot from especially retail investors that try and time the markets is they may be successful on getting out of the markets before they decline. A lot of times I've spoken to people that shortly after a market decline, they said, I was sensing a lot of risk in the market and I decided to just exit all of my positions. And now I'm sitting on cash. I'm feeling really good about it. When the market is just pulled back, that investor looks incredibly intelligent. But the reality is that, more often than not, I will hear back from that person 6 or 9 months later. And this will be after the market has already recovered, bottomed out, recovered, and is gone to new highs. And they still haven't gotten back into the market because there is no clear sign for them to do so. When the market was going down, it always looked like it was going to continue to go down. And when the market started to bounce back up, there was that cognitive dissonance that comes from not getting it on the bottom. And then the thought that the market was going to turn around and come back down. So market timing for most people do not work. Stick with a disciplined investment plan focused on value rather than reacting to short-term market movements. And just as an example, investors who didn't try and time in and out of the markets in 2008, in 2020, in virtually any market correction or crash, saw their investments recover. Unlike many of those who sold in panic, they never got back in time for that recovery. And then number 5, just the importance of emotional discipline. So controlling your emotions like fear and greed is absolutely crucial to making rational investment decisions. It's crucial to making any type of decision in your life, as I'm sure nobody is going to argue. But this is something that we see a lot in investing. When the market is going up, people get greedy. They overpay for things. They speculate, thinking that's investing. And then when the market turns around and starts going down, when there actually are good opportunities, they're too afraid to actually pull the trigger. So this is very counterproductive to successful investing over time. Focusing on just being rational and emotional discipline, it prevents these impulsive reactions. So whenever you're going to make an investment decision, you can always just ask yourself, how do I feel right now? Is this decision being made based on rational analysis, or is it being made on emotion? A practical application is just establishing your investment criteria, your long-term goals, regardless of market fluctuations, and sticking to that. So at Keystone Financial, one of the things we've always said, a lot of people, depending on what happens in the markets, if the markets are going up and they're expensive, if the markets are coming down and people are fearful, they will ask us, well, how does the current market environment change your investing strategy? And the fact of the matter is, it really doesn't, because the strategy is to focus on purchasing profitable, growing companies with strong products and services in markets where they're solving problems or providing essential services. And these are the types of companies you want to own long-term in any type of market. Now, if we're able to buy these assets at reasonable prices, then we buy. And if we're not able to, then we wait until those opportunities arise where those prices are reasonable. But that's not about watching the movement in the share price or not buying or selling because the market has gone up or the market has gone down. We always stick to that criteria, and that has helped us be successful for our clients through a variety of different market environments and crashes and booms and bubbles and recoveries over the last 25 plus years. So sticking to that criteria, no matter what. Nowadays, social media, constant news cycles, they trigger these emotional reactions, but having that disciplined strategy and always going back to that, and whenever you're making a decision, referring to that strategy is what is going to help you be successful in the market. So these are the five big ideas that or 5 of the big ideas that were discussed in the book, The Intelligent Investor. And there are many other great ideas as well. I'm sure some people would have wanted to hear a few others, but we have limited time. One thing I do want to say though, before I open things up, is that the advice from Benjamin Graham, as I said, this is many decades old advice. This is, we're basically going back almost a century here. A lot of things have changed in the market. The high level principles that he's talking about have not, in terms of emotional discipline, focusing on the actual fundamentals of the business. All of those things are true, but some of the specific strategies, the specific tactics rather, that he employed back then would not be successful nowadays. So one was, just in terms of his value investing strategy, he wanted to buy things very cheap. He was looking for an absolutely massive margin of safety. For most businesses nowadays in the current environment, you're not, if you're looking for a margin of safety to that magnitude that Benjamin Graham was looking for back then, you're not going to be investing in any good companies. So Warren Buffett actually learned this the hard way. When he first started investing, he tried to deploy Benjamin Graham's advice basically verbatim, and he ended up not doing well. And that's when he decided, you want to know what? I need to look at the high level principles of what he's talking about, but I need to adapt those for my own investing in my current market environment. And one of the things he did is he said, you want to know what? I'm still a value investor. I'm still price sensitive, but I'm not looking for the cheapest companies. I would rather buy a great company at a reasonable price rather than a bad company at a great price. And from there, he started to perform better. That is GARP investing, growth at a reasonable price, which is more in line with what we do at Keystone. Okay, so I'll
yeah, for sure. I mean, you always have to adapt, right? And I think that people who want to discard Graham's core principles are silly, because you can still use the core principles and adapt them to today's. Not adapt them so you're not using them, but adapt them so they better represent an investment strategy that you can use today. And again, that is largely the core to what we're trying to do for our clients on an annual basis.
Yeah, like one thing that really stuck out to me, like I've read The Intelligent Investor as well, and I've brought it up on the podcast before, but just, I kind of want to read just like a little bit of a piece of it here where, again, Aaron like went over it, but it's, avoid or not completely avoid, but be weary of investing in a trend that people think will do well for sure. And, I brought it up before, but they bring up the airline industry. And Benjamin says here, such an investor may, for example, be a buyer of air transport stocks because he believes their future is even more brilliant than the trend the market already reflects. And he kind of says a warning here where, for this class of investor, the value of our book will lie more in its warnings against the pitfalls lurking in this favorable investment approach than in any positive technique that will help him along this path. And then he goes on to say, the pitfalls have proved particularly dangerous in the industry we mentioned, airlines he's talking about. It was, of course, easy to forecast that the volume of air traffic would grow spectacularly over the years. Because of this factor, their shares became a favorite choice of the investment funds. But despite the expansion of revenue at a pace even greater than in the computer industry, a combination of technological problems and overexpansion of capacity made for fluctuating and even disastrous profit figures. And in the year 1970, despite a new high in airline traffic figures, that the airlines sustained a loss of some $200 million for their shareholders. So again, it's just the pitfalls of just, trying to find that next trend. That really stuck out to me. And I think that it is a great example, because if I was back in, 1940, 1950, and these airline stocks were coming out and I was a lay investor, I would have thought, we need to get it. How can you go wrong? But obviously it wasn't a great place to invest.
I mean, we saw something similar to that in cannabis, because,
Exactly.
the demand is there, demand, that's all we heard, and then everything will take care of itself. But if the demand is fed by an industry that is oversupplying that demand, even if the demand is great, you have an industry that isn't really a great investment. There was tons of revenue growth. There was not a great deal of profitability. Too many companies. I will watch the industry. There may be a point where it is, a viable industry, but it was a race to the bottom in terms of margins, a land grab, and it was a terrible, terrible place to invest for those reasons. Despite, yes, there was growth, there is demand, but that doesn't make for a good investment across the board or even in individual companies in the sector. All right, let's move on. Brennan, you're done. We have Brett, his star and dog. Or Brennan, you're not done, but
I was done.
You're
talking.
done with that comment, is what I mean. We could cut your segment. We already said we went.
Basically.
But we could do the star and dog this week. They're interesting. The star, hard to explain the share price gains and whether or not they can be sustainable in this company. We'll start there.
Yeah, so our star of the week is Bright Minds Bioscience, symbol drug or DRUG, on the NASDAQ as well as the Canadian Security Exchange. And this one's actually quite an interesting case, which is why I'm bringing up. The share price it's been very volatile and actually down today, but I'm still making it the star because it's actually been up over 45 times over the past month, which, to say the least, is astronomical. So the stock, like I said, it's up 45 times over the past month, trading at about $55 at the time of writing, but I'm sure that's changed by the time this video is posted due to the extreme volatility that has seen over the past week. The surge really began on Thanksgiving Monday in Canada, but was still trading on the US exchange during the time. So what does the company even do? The company is a pharmaceutical development company with a handful of preclinical study treatments and one BMB-101, a treatment for rare epilepsy in phase 2 clinical studies. So the company is pre-revenue, so it's running at a loss. Nothing abnormal for a company like this. There's really no surprise in the financials that's expected for a pharmaceutical development company. And there was no news prior to this surge. So why did the stock just surge? The company even stated it had no material change that could result in the surge, and they did actually take advantage of this surge, raising $35 million US in proceeds, which is actually, they raised more than what their market cap was worth last month by a factor of about 8 or 9. So they took advantage of it, which is honestly the smart decision to see a company do when you see these really nonsense surges at the time. So one of the speculations is the company developing a similar like Longboard Pharmaceuticals was acquired for about a 50% premium, which then in turn caused a short squeeze of Bright Minds as people say, oh, this drug got acquired for this much, it was 50% premium, so you'll start to see people pile in there, and that in turn then caused a short squeeze, further pushing the share price higher and higher, causing more shorts to cover, of course, as I'm sure most of our listeners have heard many times what short squeeze is. So, and in addition to that, you had more investors as the news spreads start to pile in, especially in the age of social media. Aaron was touching that on in his segment, is when you start to see these headlines the same day of the same hour of headlines appear, this stock is up 100, 200, 300%, more people pile in, and you see that more and more commonly in these dramatic short squeezes. It's not necessarily the only factor with these things. You can't be absolutely certain that it is just a short squeeze. There can be other factors at play. It can be a big shareholder coming in place that doesn't have to be publicly announced, but likely short squeezing here was a major part, if not the reason. And just to show up a bit of quantitative proof is the borrow rate just went into the hundreds of percent, so that's quoted on an annualized basis, and you can see that just spikes up there in that the red line on that chart there, and it got up to about 1,100%, which isn't displayed on the chart, but that was the all-time or local high for it, and it's still about a 400%. You have to pay 400% of the stock you've borrowed value to even have a short in place, if you could even borrow it. This is off Interactive Brokers, and they actually had no shares even to borrow in their inventory at the time, and they normally have a decent amount for at least retail investors. So really what I want to highlight with this event and Bright Minds as a whole is that the market can just be inefficient in valuing the underlying company when certain conditions arise. There's no stock or company that, unless something absurd happened, that will go up 45 times, 50 times within a week. That's just unreasonable, and that's absolutely absurd if you're looking at the company's operations. So market's inefficient in some ways. But for now, really, it's our star of the week.
Yeah, I mean, it's just a company. It's really hard to figure out. It looks like there's some speculation on the acquisition there. It's one that we cannot value at this stage, and I wouldn't be surprised if there is no further news on an acquisition that you'd see a significant drop in the share price, as they still have a long road to go to commercialize. So, the valuation right now seems excessive.
Yeah, Brett put it on my radar last week, and he was like, "Hey, did you see that drug stock?" And I was like, "No." And he's just like, "Oh, it's all over the internet right now. It's just going ballistic." And I'm glad that you covered it, because I'm sure that there's a lot of people that are wondering what's going on, just because it's all over Reddit and whatnot. So yeah, I think it's good.
And we just did a segment on investment versus speculation, and this is one that would just classically fit in the speculation basket.
Yes. So when I saw it, it was on the Tuesday after Thanksgiving Monday, and it was the Canadian exchange was up, I think 200 or 300%, which is already an extreme increase for any company. And it just continued to rise throughout the day. And by the end of the day, it was up around 25 times on the Canadian exchange, and it would have, just because the holiday was about 15 times on the American exchange, somewhere in that ballpark. And it just shows, as this news spread, people just started to buy in just to speculate, like Aaron was saying, and you just have the people, they want to just risk their money, throw it in the casino, and hope it turns out well. Hope the short squeeze or other people keep on buying.
Yeah.
But a lot of the times that's not going to be the case.
Just don't do that. To our listeners that are today, just don't do it, because it just will not work out. The more you follow this strategy, or it's not even a strategy, the more you follow
any of those stock forums, if you're seeing that the hot post, whatever hot stock board of the day, and you see that getting tons of volume, be very cautious.
Yeah.
All right, let's move on to we have Brennan's segment, right? Coming up.
Dog. Lucid.
Oh shit, the dog. Sorry.
There you go. So our dog of the week is Lucid Group, LCID, on the NASDAQ. The company designs, engineers, and manufactures electric vehicles. The current share price is about $254 with a market cap of just under $6 billion. The share price is down 26% over the last month, but it's down a whopping over 95% since its all-time high set in late 2021, which is a recurring theme with many of these more speculative companies. So first, look at why the company has been on a decline really since 2021. First and foremost, the company's valuation was just extreme at the time. It was just very, very high, on top of the general feverish broad market valuations at the time. The company was just beginning to start customer vehicle manufacturing in its Arizona facility. Optimism was high for Lucid as a whole, and as well as the market, which resulted in a massive market cap peaking at $91 billion with an order book. So what they're expecting for future revenue, not even current revenue, of $1.3 billion. So huge, massive growth was just baked into the stock price at the time and the company as a whole. Now, just under 3 years later, what has the company done? They were able to have at least commercial production and delivers in 2022, but growth has been very, very, very underwhelming compared to what was expected at the time, implied by the stock price. As of the last quarter, Q2 2024, the company delivered 2,394 vehicles, resulting in revenue of about $200 million. On a per share basis, that's only 9 cents per share. That's lower than the all-time per share revenue of 15 cents, all-time high per share revenue. And that was just set in Q4 2022. And that Q3, Q4 2022 was really that's when they had their initial bookings hit and were actually sold. Roughly the same, and that per share revenue has been roughly the same since Q1 2023. Even with rising absolute revenue, the per share dilution has just further hindered any per share growth. So over the past few years, the company just has not been able to really keep up with any implied expectations of growth given by its price at the time. Now, looking into the last month, the reason why we saw the stock just fall 26% over the past couple of weeks is that there was another stock offering of 262 million shares and a further private placement of 374 million to the majority shareholder, the Salty Public Investment Fund, which owns 59% of the company, and they were offered that to keep their share ownership the same. Effectively, they run the company. Here, together, those two offerings raised approximately $1.67 billion and raising the share count by about 27%. So overall, really, you have a poor financial performance, burning just large amounts of cash quarter after quarter, year after year now, and the need for cash injections through dilution in a significantly now poor environment for capital raising compared to a few years ago just really has resulted in this poor stock performance. And really, there's a lot more pessimism now than what you would have seen even a couple of years ago or a year ago, which has just devastated the share price and made Lucid our dog of the week.
Yeah, I did a little bit of a look at Lucid in our 2023 electrification report. And I mean, at that time, I mean, we could look at it now to continue to see how much they've been burning. But at that time, it was as of March 31st, 2023, the company had an accumulative deficit of 8.1 billion. So, I mean, that's essentially like money that they've been just like burning or investing. And again, they're not nowhere near profitability. It's just grim. I feel like in the space,
It looks gross to me. I wouldn't be
Yeah.
anywhere near it. Yeah. I mean, it's really sometimes, I don't know if we need to delve in that much deeper than, there was revenue growth. The revenue growth is even plateaued really here. And it's, the losses are extensive and it doesn't look anywhere close to profitability. That is a capital intensive industry.
Yeah.
Good luck is what I would say in that business at this stage, unless it gets acquired or I don't know.
It's capital intensive and they're even though you do get some economy of scales in your cost of goods sold, they're not even making a gross profit at this point. So even at the time they're losing money per vehicle, they're not selling at a high enough price effectively.
Yeah, it's ugly. Yeah, let's move on to Brennan. He's going to look at BluMetric Environmental Inc., symbol BLM on the TSX Venture, a company that we have interviewed management in the past. Again, not a bad business, but he's going to go through it. It's considered a microcap in the Canadian market.
Yeah, and that's the thing. Like, it really isn't a bad business. It does check off some of the boxes, but let's go through it here. So this came in from Gene via YouTube. It was a YouTube comment. Again, BluMetric Environmental, BLM on the TSX Venture, currently trading at a price of about 74 cents and a market cap of just under $25 million. So they provide clean technology and professional services or environmental consulting in the fields of environmental geosciences and engineering, industrial hygiene, occupational health and safety, renewable energy, water and wastewater treatment, environmental contracting, and environmental management. And if we look at the breakdown of revenue by market in the last quarter, about 42% comes from commercial and industrial, 18% from government, and 21% from military, and about 19% coming from mining. And the company is really the go-to water expert for the Canadian National Defence and the Royal Canadian Navy. So this is a stock that we followed for some time, given its fundamentals, and we actually interviewed management back in 2021 while the stock traded in the 60-cent range and had a price to earnings multiple of about 4.7 times. So it looked cheap then. But while the company did trade with low valuation multiples and maintained a healthy balance sheet, the growth outlook going forward remained in question, and the CEO had very little insider ownership, which essentially resulted us to stay on the sidelines. Now, looking at the financial results for the most recent quarter, Q3 of 2024, ended June 30th, 2024, revenue was up about 17% to 8.1 million. Just keep a note that it is quite lumpy. It is a contract driven business, so it can be quite lumpy, the revenue. Adjusted EBITDA was 302,000, up from a loss of 674,000 for Q3 of 2023. And net income was only $26,000 or 0 cents essentially per share, compared to a loss of 729,000 or 2 cents per share in Q3 of 2023. And if we look longer term, we can see that there really hasn't been a good trajectory of growth in revenue or EPS, as since 2014, revenue has grown with a compound annual growth rate of just 2.8%, and EPS has been very volatile. And this was really one of our questions when we did speak with the CEO back in 2021 is, what's the growth strategy here? And looking right now at the trailing valuations, the stock trades at about 23 times trailing earnings and about 14 times trailing enterprise value to EBITDA. And looking at the balance sheet, it had about 2.2 million in cash with 3.1 million in debt and leases, providing a slight net debt position of about $1 million. And the company has a trailing net debt to EBITDA multiple of about 0.5 times, which is reasonable. But just to look here, if we didn't include leases as part of debt, the company would have a net cash position of approximately 1.7 million. Now, some operational updates. On September 24th, 2024, BluMetric announced the acquisition of Gemini Water, which designs, builds, installs, and commissions large-scale desalination and wastewater treatment systems across 22 locations in the Caribbean as well as Texas. And the purchase price was about 4.1 million Canadian. And they also issued about 2.35 million shares of their stock. And for the trailing 12-month period ending June 30th of 2024, Gemini's revenue stood at just under 10 million Canadian, with EBITDA margins exceeding 10%, they said, their historical EBITDA margins. So note that the balance sheet will be impacted by this deal, considering it was closed after the last quarter. But if we just do some napkin math, and if we use the forward EBITDA margin of 10% on its revenue of approximately 10 million on that acquisition, and also include that $4 million purchase price impacting the balance sheet, I get an approximate forward enterprise value to EBITDA multiple of about 10 times. So it looks a little bit more reasonable. Now, on September 3rd, BluMetric provided an update and growth initiatives, including focusing on the clean tech side of the business. That's what they indicate. And they also wanted to expand its geographic footprint outside of Canada. And they're also looking for potential acquisitions, such as the one that they made with Gemini Water, looking into the US and the Caribbean. And lastly here, just on October 14th, the company also began trading on the OTCQX under the ticker symbol BLMWF. And the CEO indicated that the trading debut coincides with the company's strategic expansion into the U.S. market through its recent acquisition of Gemini Water. So that really seems to be what the growth story is now. Geographic location, tapping into the U.S. But let's conclude here. So again, I think BluMetric is a decent business, but growth has been quite minimal over the years. The company has a solid balance sheet and remains profitable. But given the minimal growth over the last decade, fundamentally, the business remains pricey on trailing numbers. But if growth can increase, its 10 times enterprise value to EBITDA multiple looks more reasonable. But whether there's an opportunity there paying that price, it's really up to whether that growth, will ramp up, I guess. So again, I think that BluMetric is a good company, but the growth remains under question, which is really, a show me story. The geographic expansion strategy looks good on paper, but we need to see management execute on this. As in 2021, when we spoke with management, the growth story that we heard at that time was really focused on expanding its mining revenue, or at least that's what I was writing down in my notes and what I got across. Now, if an investor wanted to take a bit of a flyer and bet management will be able to ramp up growth, there could potentially be an opportunity. But again, it's higher risk. And this is what they would be betting on, which, of course, there's no guarantee. And, just going off of our previous kind of conversation, I'd on insider ownership, I'd also like to see the CEO have larger insider ownership, as he only holds about 61,000 shares, which is quite minimal. And his last purchase in the open market was in September of 2022. And, I'll also note that when we spoke with Scott in 2021, he had just exercised over 500,000 options at 24 cents, but immediately sold them into the market at 72 cents per share, which was a bit of a red flag to us at the time. Given if he held on to the shares, it would have been a much better vouch of confidence for future growth. And I'll just pull this up here. You can see that, looking at like total insider ownership, They do have management and board of directors does own, 6.7%, and current and former employees and insiders own about, 33.7%. I believe the initial founding CEO owns, a couple million shares. So there is insider ownership here, but, I'd really like to see the CEO, increase that position. And we really haven't seen him buy much, since, 2022. And his insider ownership really just remains small with, only 61,000 shares that he holds. So yeah, that's my segment. Again, good company. But I think that, you're just really gambling more on whether growth will continue. And it's a contract driven business. We might all of a sudden see, revenue come down and, earnings come down, and the stock price also, again, coming down, which we've seen time and time again with the stock.
Yeah. And there is a contract that they are executing on right now that's coming through to in 2025. And that has impacted margins in the near term. But again, the valuations right now are kind of factoring in that contract will come through. They will execute on that in 2025 and have better margins. So, we think it's probably fairly valued just where it is right now. We'll continue to monitor it.
Fairly valued, assuming that growth comes through.
Yeah,
I would argue overvalued.
Yeah.
In my, if I were looking at 10 times EV to EBITDA forward, no historic track record of growth, barely breakthrough earnings, I'd want to see that at 3 to 5 times EBITDA myself. Now, I'm not saying the stock price is going to go down in half. I'm just, that would be my margin of safety.
No, I mean fairly valued if they execute on that contract over the course of this year. Yeah. So what is your upside? Potentially they execute on it at a far better rate. But again, at 10 times, it's a 10 times EBITDA margin that you're valuing it based on, right?
Oh yeah. Yeah. EBITDA margin, or at least that was what they were doing for the acquisition.
Okay.
Yeah.
Okay.
On the actual, so trailing,
look at trailing
14 times, right? EV to EBITDA is what I remember. Yeah. So even,
yeah. Okay, good. I think that'll close off the show for this week. I'm getting nods, so they're telling me yes, it does close off the show. I'm kidding. All right, but again, keep your questions coming into our Your Stock, Our Take segments, and we'll continue to answer those on a weekly basis. If you're watching us right now on YouTube, smash that subscribe button. If you're listening to us wherever you consume your podcasts, rate and review us on there. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.